a pure risk mitigation product, right? It's basically you take care, or the life insurance, or for that matter, any insurance, is basically a risk mitigation product, which is supposed to take care of any unforeseen event. If something is supposed to happen, if you are very well know that, say 5 years down the line, this is going to happen, you will start planning for it to add a lot more customers. In fact, if majority of the population actually buys a term plan, it can actually become cheaper.
Yeah,
right?
more people will come obviously.
Correct.
Then.
But currently, the number of people who actually buy a term plan is still not very high. In unit link, the fund can also go down. It can go up, but it can also go down. Similarly, in the non-par segment, you have a guaranteed one. In case of a par, the guarantee component might be a little lower, but there is a possibility of an upside.
When we talk about life insurance, then experts suggest buying term life insurance policies, in which if something happens to a policy holder, then his or her family members get the life cover. Now, if the policy holder survives the policy period, then the policy holder and the family, they get nothing. This is the reason why people prefer buying savings linked insurance policies like ULIPs or endowment plans, in which if a policy holder survives the policy period, then they get some amount as maturity. Now, but buying term life insurance policies make better sense, and there are some life insurance companies which focus more on their term insurance business over their ULIP or endowment. I have MD and CEO of Bandhan Life, Satishwar B. His company Bandhan Life is one such insurance company. Welcome, sir, on the show today. And today we'll talk all about term life insurance policies. So maybe let's begin with product mix in your company when it comes to term ULIPs and endowments.
Thanks for the introduction first. So, see, two things. One is, yes, I actually look at product mix more in terms of number of policies, which basically means the number of customers that you have onboarded.
Correct. Number of policies sold.
Correct. So, number of customers that you have actually onboarded, right? Because your term size, ticket sizes are much smaller than the savings component. Correct. So, if I look at on those basis, if I look at my product mix, we are more than 50% actually term policies.
All right, meaning you are selling more term insurance policies over ULIPs and endowments in terms of number of policies.
Correct. So that and that's with a very conscious one. We did some major changes to make that happen. But broadly, coming back to your question, the product mix more than 50% is term, say closely around 55 odd percent.
Nice.
And another 25% which non-par savings, and the balance is more towards par and unit link.
Now, if you can explain par and non-par, because to our maybe audience, they won't understand participatory.
Or rather, let me actually give you the entire concept on life insurance itself, right? So broadly, you can categorize life insurance products into two buckets, right? One is the term plan, or which is the simplest form of life insurance, which is the purest form of life insurance, right? Where you basically pay a premium, and in case if there is death of the policy holder, the dependents or family holders or the nominees, they actually get a lump sum. And normally, the multiple of the premium that you pay and the sum amount, the sum assured or the life cover that you get against this life insurance policy is quite say 400, 500 times of that premium, right? So it's a pure risk mitigation product, right? It's basically you take care, or the life insurance, or for that matter, any insurance is basically a risk mitigation product, which is supposed to take care of any unforeseen event. Right. If something is supposed to happen, if you are very well know that, say 5 years down the line, this is going to happen, you will start planning for it. You don't get insurance for it.
Right. That is not insurance.
So this insurance is a risk mitigation product. The risk of, say, me dying early, right? That's what specifically the term life insurance product take care of. Broadly, life insurance actually takes care of two extreme things. One is dying too early, or living too long. Correct. Now, how does it take care of living too long? Living too long is basically in the form of annuity, right? So you basically create a corpus, and using that corpus or a lump sum, you create a huge amount of money, and using that corpus, you basically start getting monthly income post your earning age, right? That's where the annuity comes in. And this is where the third category comes in, which is basically creation of the lump sum, right? Which is basically all your accumulation product or the savings product. Right. So broadly, three product categories. One is, say, term plan, which is the purest form of life insurance. You pay a premium, get a lump sum in case of death of the policy holder. The family is taken care of, at least in terms of the financial dependencies, right? So financial well-being is taken care of. Emotional well-being can't, but at least there is no financial well-being. Right. Second is the annuity product, where you basically take care of your retired age and you get monthly income or annual income on a regular basis till the time you are alive, right? Third is the accumulation product, which is also called as a savings product.
So do we understand that annuity is non-par, or I believe that within savings link there are par and non-par?
Yeah. So annuity is largely non-par, right?
Okay.
So annuity is more or less a single premium product and then an steady income. But then you have variations where you basically start building the corpus for the annuity and then start getting the annuity, right? So both can come. So savings is more building that corpus.
Right.
Now savings has par and non-par.
Again.
Like par stands for participating and non-par stands for non-participating.
Yeah, so participating meaning company, so whatever profits company earns, they share it with the
Correct. Let me put it the other way around. Let me first explain non-participating. Okay. So non-participating is very simple. Basically says this is the kind of premium that I will pay over the next 5 years, 10 years, 15 years, whatever number of the premium payment term that you choose for. And then this is the money that I will get. So the money that I as a customer, as a policy holder, I have to pay, that is identified. And the money I as again a policy holder, post this period, the money that I will get, you can also decide whether I get it on as a cashback in terms of say monthly income or an annual income, or I can also lump sum, right? So these are guaranteed. You're upfront knowing when you buy the policy, you exactly know what is the amount of premium that you will be paying and what's the kind of money that you will get, right? And the whole whatever investment management or the risk associated with interest rate movements, anything is the responsibility of the life insurance company to take care of.
Correct.
Right? So it's guaranteed for the customer, and that's the non-par definition. So what you get is the other one, which is participating, where the payment terms or basically the premiums that you pay, that more or less remains same as the non-par, but the maturity or the maturity proceeds or the benefits that you get, that can change. Now in that case is where the pool of money that gets created under that segment, the participating policy segment, that also gets invested into the market. Now as I said in the earlier one, the outcome is guaranteed.
Fixed,
in this case, if the participation, the policyholder also participates along with the life insurance company, where in case if the interest earnings is wonderful, right? You actually do much better. The environment or the market environment is something which actually enables you to earn more. That benefits also get shared between the policyholder and the company. Similarly, in case the experience of the number of people who continue to stay with that product, if that happens, that experience is all the experiences, right? Experiences can be in the form of investment income, experience because there is a death cover associated, experience can also be in the form of mortality, which is the death. When you price a product, you assume that certain amount of people will not kind of complete the whole tenure, but can on account of say death or because of certain other aspects they might exit, right? So all those things are also called as participating. This has an impact on the end maturity amount.
Correct.
So यहाँ पे both the customer as well as company, they kind of pull it together and then those experiences gets factored in. That's the reason it's called as participating. So they actually participate, but some base guarantee is given. It's not that it is absolutely no guarantee. So there is some amount of base guarantee given.
Over and above, profits can vary.
It can go upside, the base guarantee, and you can actually get much above that. There is a possibility that, and this much above can vary based on what the actual experience is.
You gonna receive the base.
There is a base guarantee which is given when you buy a policy.
Okay, now coming back to term insurance, I believe that term insurance is not about whether you should buy it or not, but whether you will get it or not. So when I bought my own term insurance policy, then I realized the process is quite stringent. It takes time. You have to first fill up you have to declare so many information, then proper medical checkup also gets done. Then again underwriting takes some time. So the process is stringent. How to simplify it so that more penetration in term insurance can happen?
So how many years earlier did you buy the policy?
I bought very recently, 2-3 months ago.
Okay. No, so a lot of development has actually happened and you will see the process being made much simpler. In fact, earlier, if you notice, say 4 or 5 years earlier or even 10 years prior, life insurance, especially the term plan, was more was catering towards the salaried segment. Because a formal form of employment, there is income stream and those kind of things, right? So I can understand this challenge. But over the years, and if you actually take our own example, and we figured out that this is a supply side issue, right? And we figured out that we need a solution, and this is where the whole digital and data enabled underwriting has actually helped us. Okay. So what we are talking about is broadly, if I want to simplify, when you do an underwriting, there are two parts of underwriting, right? And as I said, insurance, especially term plan, first let me explain the product again. Term plan is a risk mitigation product, right? So when you buy a term plan, you're basically is supposed to take care of an unforeseen event, not a certain event, right? There is a possibility of an event can happen or an event can't happen, right? This is where a term plan comes in. Otherwise, how do you justify a 10,000 rupees and a 1 crore cover, right? If it is a certain event, the premium doesn't work. So it's a pooling mechanism. A lot of people buy, and
then that
some of them actually say die. Then in that case, it's the pool which basically takes care of it. Now it's only fair that this entire set of people who are buying a policy, there is no anti-selection. Now what do I mean by that is they are all one homogeneous group. When I say homogeneous, age of course is factored in accordingly. You have an actuarial science which basically talks about what mortality age and what is the kind of mortality rate. You factor that in, which is considering that space. So whenever you have somebody who is an anti-selection, that can skew that thing, and that's the reason why you do a lot of underwriting to kind of take care that somebody who is not in his deathbed, or we also have cartels which are basically working.
Totally.
So those are fraud element. But irrespective, there is a huge
Screening
amount of
must be
customer
there.
segment who genuinely need it and genuinely there, right? So broadly, two underwriting. One is the health angle, which is basically ensuring that the health parameters are found, because if there is a certainty in terms of death, naturally it can't be because it has to be an unforeseen event, right? So that can't happen. So that's the reason why the health happens. The other aspect where the documentation has been a concern, because health, irrespective whichever you look, it's a simple one. You get your medicals done and that's it, right? As far as the other one where the documentation comes in, is basically health insurance, or sorry, the life insurance, right? Especially the term insurance is, again, as I said, it's a risk mitigation tool, and it is supposed to take care of the income which will not be available to the dependents if the policy holder dies, right? It's ideally supposed to take care of that income. Right.
It's not that one can go and buy 5 crore.
Correct.
You may
so
not
that
be
is
eligible for it based
so
on
if
your income.
if I am earning, say, a lakh rupee a month or a lakh rupee a year, just for simplicity purposes, right? Then say a 10 time or a 15 time multiple based on your age. Suppose if I am very young, I might actually even suggest a 25 times policy. But if I am more in a middle aged guy, right, say anywhere between say 35 to 45, right? And there I would suggest a 15 times or a 10 times cover. Now in this case, middle aged is 35 actually is a young age, right? We call it as middle age because the insurable age is largely your earning period, right? The time when you are actually working and not the entire life. So it is supposed to take care of this income stream. If this stops because of death, the life insurance policy will kick in and ensure that the dependents still get that money, right? Now to ensure that a person who is actually needing a 50 lakh rupee cover or a 1 crore cover doesn't actually then apply for a 10 crore cover, or somebody who is actually applying even for a 1 crore cover, his income and the sum assured that he's asking for, those are in kind of sync, is where the financial underwriting happens. Right. So it's basically establishing what your current earning is.
The still pool has to get widened. So that screening is important. That is there. You need to create that pool and no mismatch of people, policyholders coming up front. But if we look at self-employed, then when we apply for term insurance, then they ask for salary slips, asking for your income tax returns. But how do self-employed get good insurance? Because in a lot of cases they don't get it, even though they are earning well, but still they don't get it.
This is where, as you said, the pool has to become bigger, which basically means that we have to add a lot more customers. In fact, if majority of the population actually buys a term plan, it can actually become cheaper. Right?
More people will come, obviously.
Correct. But currently the number of people who actually buy a term plan is still not very high. Right? But in our case, if you actually look at, and that's the one piece basically said, a larger population in our country are actually in the any kind of non-formal income stream, or rather basically non-salaried, and that's where we call them as self-employed. But I would actually define the definition a little further. Self-employed
Okay.
for us also includes students and homemakers. Okay, so basically it's a larger definition. For us, wherever there is a dependency, I think that needs to be covered. Right? It might not directly be associated with actually an earning. Right?
Correct.
For example, if a homemaker, right, the breadwinner is actually very much dependent on the homemaker to go and actually make that earning. Right? So there is some, so you can't put a value to it, but then there is kind of a lot of dependency, and that actually encourages and enables the breadwinner to go out there and make the living. Right? So to that extent, there is a value which we basically claim it as these 50% of the breadwinner's income, something on those. But is it absolutely right? It's a proxy,
but yeah,
right?
one
It kind of
parameter.
helps. So similarly, students, right? There is a lot of education has become costlier. The parents might have funded it, or they might have borrowed it, right? So when they reach a specific age, there is a lot of investment which has already gone. I'm not saying that that is more to take care of his future income, but in case if something happens at an early age, it's a huge amount of burden on the parents. So even students we are covering. So anybody where there is kind of a dependency coming in, that comes in. As far as the income determination is concerned, this is where we moved into a lot of things which is called as a data-driven strategy.
Okay.
Right. So one, it of course became digital, and the other one is data, because even the self-employed segment, or they now have started using the digital means a lot.
Okay.
Right. So that kind of helps us do that.
If you can elaborate, huh?
Yeah, but just to give a flavor for us, right, in our customer segment, more than 60% are the self-employed segment over the last 2 years, because we introduced this whole data-driven underwriting model around 2 years back.
Okay, so
Over
you
the
have
last 2
sold
years.
term insurance to
Term
self-employed,
insurance to self-employed, and the self-employed segment is now more than 60%.
Okay.
Right, so more
That
than
is
60% is
commendable.
actually self-employed, which if you actually look at our own data,
Yeah.
say close to 2 or 3 years prior, it used to be more than 90% salaried.
Okay.
Right. So which
Okay,
kind
so
of
it has happened in last 2-3 years.
Yeah, there has been a
The
very
shift has
conscious
happened.
shift in terms of catering to that specific customer segment, right?
Okay.
And enabling those on, which is for us, it's we call it as the zero doc, zero ops model.
So how does it work out? How do you then
So
get
we
into
basically
their
look at
underwriting?
third-party data sources. The way you can actually now borrow money, right, even without actually having those very formal documentation,
Yeah.
right? A similar model.
Credit underwriting has improved.
Correct. So this is basically, we have also similar borrowed on the similar line. So there are various different parameters that
Maybe
kind of
tracking their expenses, their banking
No,
transaction
so
data.
that again
in
becomes
sense?
documentation,
Uh-huh.
right? But there are certain behavioral trait which comes through various. For example, I'm just giving this an example, but there are multiple data sources that we follow. For example, the CIBIL score, right? So that's again, which you can actually get it much easily rather than uploading a document, right? But there are other similar pieces which are data sources. We tied up with some 20 odd data sources, which the customer basically provides a consent, and then we get those sources. Not all the 20 data sources always doesn't get a hit. You will get a hit from say 4 or 5 of them, and that gives us enough confidence in terms of going with the non-medical underwriting without asking for any documentation.
And for same risk profile, same age, premium for a salaried and a self-employed will differ, or
No,
be
for
the
us
same?
it's the same one.
Okay,
So
it's
the
the
product
same.
is common.
Yeah.
It's the underwriting which has actually enabled the self-employed to come and buy. In fact, for us, we actually, the base pricing is the same. In fact, for self-employed, we came up with this proposal of a 10% discount on the first year commission, or the first year premium, sorry.
All right, that's
So,
interesting.
because we wanted to specifically bring out saying that we have designed this
it's a left
product.
out segment, and you
Yeah.
are catering to it.
Because the mortality, that we haven't distinguished. So that for the age and a specific health profile, those remain common. So that we have not distinguished. But yes, it's the data-driven underwriting, the data sources, the way you said credit. We also introduced something where the data itself is not very limited. We get into an interview session. That's the way, even if you notice, credit assessment happens, right? So we do that. And
Okay,
then do
proper video interview in
A
that
video
sense,
interview with the customer.
understanding their financial situation,
Correct.
their work, etc.
Yeah.
Okay.
The CKYC has become digital, so that gives us more confidence. So anything, in fact, rather than having scanned images, if a data actually comes from the relevant source directly, the confidence on the data goes up.
Correct.
Right?
That
And
is
that's what we have kind of built into our processes, and it's working. It's actually
Correct.
working.
All right. So self-employed, understood, homemaker, very simple, 50% of the earning spouse. And then students, how do you do underwriting in case of students?
Students, we basically look at what is the kind of course that is doing, right? So
Okay.
professional courses, we don't directly start with a huge number because the initial needs might be much lower.
Okay,
But
if somebody is
there is-
pursuing MBA, they are
Correct.
studying at IITs, IIMs or any other premier
so
institute.
across the
then-
course, but then you will kind of, so it's
So
more based
you'll-
on the future prospect.
Exactly. So
Yeah.
you will try to identify their future earning potential and impact on
Correct.
parents. That is how you will
Yeah,
do
so
it.
some immediate pieces. So it's more to take care of any sudden impact. The family gets some more time to settle down on those lines.
Right. And now about some other left out segments. So I have seen a lot of people have talked to me about this, that for example, take a case of organ donation. So I know a lady who donated organ to her father. Now she has maintained a good life so far, and she still maintains good life, and health parameters are strong, everything is fine, but she is not able to get a term policy. So this is one thing, because she has donated an organ. Similarly, somebody may have had a major surgery, and that surgery itself became a reason for them to maintain a healthy lifestyle. Now they also don't get term insurance even though they are quite healthy now. Similarly, could be other, a person may have gone through a brain stroke, then again they will not get term insurance. So how to tackle this challenge, because again a lot of population then again gets excluded. Maybe
easiest-
taking higher premium, but at least they should get the term insurance.
No, the easiest solution, I think, is start early. Okay, and
Yeah,
that's
that
what
is
we have
there,
been
but
promoting. And
lack of awareness or for different reasons.
I
people
would like to
don't-
counter that, right? So in fact, if you actually ask anybody in the market or anybody in the field, wherever you meet any of your friends, relatives, whomever you know, or even any
Right.
general, when you're meeting somebody, a stranger, right? Ask him what is insurance, he will exactly tell you what is insurance. I don't think that's an awareness issue,
Yeah.
right? Ask
But
him,
term
do you
insurance
need it?
awareness issue.
If you ask insurance, everybody thinks it's a term insurance.
But they have some negative perception about it. They know
That's not the
insurance, but
reason
then they say पैसा मिलता नहीं है. That is
ऐसा
the
नहीं है, मतलब, which is not true at all.
Yeah.
Right? जो पैसा नहीं मिलता है, those are the only cases where there has been a very grave non-disclosure, not a minor non-disclosure.
Right.
There has been a very grave
At least in
non-disclosure,
life insurance,
which
this
is
is the
very
case.
well governed. So I can say with confidence that any claim that we would have repeated, though our claim settlement ratio is 99.66%, right? Any claim that we would have rejected, that's either it has been a fraud case, a very clear fraud case where a person is about to die and then you buy a life insurance policy for him, right? And that's a cartel. Or you're already dead, even that cases comes through. So moment you try and ease your underwriting, this kind of fraud instances come in. Or the second one is basically there has been some major health hazard that has happened, right? Or the way you said, a major surgery, and that has not been disclosed, right? So those are the kind of cases where it comes. So the disclosure becomes critical. Whatever it is, you need to kind of disclose, especially all those health related questions and your income related questions, right? Those become very critical, and disclose it as honestly as possible.
Yeah, that is there.
Right? If
But-
that is there, claims is 100% guaranteed. There is no way.
In life insurance, I agree that in very less
a
cases.
claim will be rejected. No ways there.
But
coming
then, the
coming back to
question-
the health wala thing. So of course, this ideal solution, start early so that, because now, as I said, right, this has become an event which has happened, right? In your own example, or rather, if you just check health before this instance and health after this instance, though you are maintaining a good lifestyle and everything, that's because of that instance, right? Will I ever be as I was earlier, right? So that's the reason why, and as I said in the earlier case, it's that pool of people where we need to avoid anti-selection, because then the impact is taken on the rest of the team, right? It's kind of in a way participating.
So has
but-
this study been done in underwriting that they are more at risk?
So
Obviously,
with
they
the
may
health,
not.
with the health advancement that has happened, right? A lot of things has changed. So earlier it used to be very difficult, but now for all minor surgeries, for example, let's call it as surgeries where you can happens in a day itself, right? You can come out of the treatment and back home in a day or something like that. I'll just in a simple terms, minor surgery. There, within a year from that surgery, it's normalized. The premium is normally normalized. For any kind of major surgeries, the earlier it used to be more than 5 years. So if you wait for 5 years, and post 5 years is basically more or less the normal term. And within this measure also there are some, for example, a bypass. Now the waiting time is only 1 year, right? So with the advancements coming in, where the confidence levels are going up, right, there it is now started coming in.
But
So
cancer, brain stroke, all these major
there
illnesses,
we will have to
it's
wait
no.
for the health advancement, which gives us much more confidence, because you would have also heard relapse, right? So those are the cases which are still coming through.
Yeah.
And that's it. The best solution is start early.
Start early.
Start
That
very
is
early,
right.
because it,
Okay.
in a way, right, the trigger itself is a health hazard,
Could not be.
which is, if a
Yeah.
trigger would have been some death in the family, that's a different story, because that's
Yeah.
awareness.
Right.
This one is a little
Different.
difficult. But having said that, quite a few cases are now getting covered because of the health advancement. So the confidence in terms of the life insurance companies to also cover, that has increased. But we will also see that all these cases, the restriction is largely till the age 60.
Right.
You will not try, which is very ideal. You should also buy a policy only for your earning age. You will see a trend that people are actually trying to buy till 80, 90, or even at times 100, right? So it's a certain event. Naturally, your pricing will be higher. It's ideally age is 60, 65, up to age 60, 65.
Okay, now if somebody is not able to buy it, they are not eligible for term insurance, then what is the second best option?
Let me actually address it, a little lengthy answer though, because I will just use this as an opportunity to see a pure term, right? A pure term plan is a pure risk mitigant tool. Okay, it is supposed to take care of the income stream to continue for the family in case of the policyholder's death, right? That's the simplest of the concept. So ideally, and it should ideally be brought in at an early stage, because you have not yet kind of accumulated wealth. In a normal personal lifestyle, if I have to do my own financial planning, right, the moment I started working, or even I am getting into advanced education, right, is where I would want to buy a term plan, right, because I have not yet started, I have not accumulated wealth. But parallelly, the moment I start earning, I will actually also in parallel start accumulating wealth. Now assume a scenario where by age 50, right, I have accumulated enough wealth, right, which basically means that in case if something happens to me when I am age 45 or say age 50, let's take continue that same example. In that case, my family is not going to struggle for a steady financial stream of income, because I have created enough wealth or accumulated enough wealth which can take care of it. So you don't actually need an insurance in that case, right? Insurance is more relevant when you have not yet accumulated wealth. So it's a risk mitigation, and that's how ideally every individual should plan his financial journey. And there are of course various other savings and wealth creation opportunities that you should do, but it enables the wealth accumulation to happen. By that time, if something happens, it's taken care of. The family doesn't have to suffer, right? In this scenario where we are talking about is largely at a younger age, this doesn't happen, the major surgeries, and largely happens at a later stage. So in case if you buy an insurance policy upfront, this incident is taken care of. If somebody has not been able and they can't get a term plan later, the option is largely savings product, right? A savings product now.
But
there are
in
products
savings products, which one? That's what I
doesn't
wanted to
really
focus
matter.
on.
So both, it is
Don't
more.
you think that it's high sum insured ULIP plans?
High sum insured ULIP plan will also have similar underwriting as term plan.
Okay.
So up to 20 times is where the underwriting can be a little liberal, because the risk which the company is taking 20 times of the premium number, right? Whereas in the other case, it's say 40, 50 times of the premium number. Naturally, the underwriting process will be more stringent or similar
so
to a
then
term
similar,
plan.
then they will
As
not
far
get
as
it.
par or ULIP or a non-par,
Here, no.
that is more the customer's appetite, the risk appetite.
Because premium is huge.
Premium, every time it's a 10-time cover, right? So what is that he wants to do, or he or she wants to do more in terms of what is his risk appetite. In unit link, the fund can also go down. It can go up, but it can also go down. Similarly, in the non-par segment, you have a guaranteed one. In case of a par, the guaranteed component might be a little lower, but there is a possibility of an upside.
Correct.
Right? So what is that I am more comfortable with as a customer, and choose that one. So any of the product category, the 20 times cover, largely it's available in unit link. To that extent, yes. but a savings product is the option.
Right. Okay, thank you so much, Satishwar, for sharing such great insights with us. Really interesting conversation with you.
Thank you very much.